All right, everybody, welcome back to Alternative Finance. My name is Alex, and today we are moving right along with our Investing 101 series. Yesterday, we were talking about bonds. Today, we're talking about stocks, baby. So real quick, before we jump into this, I want to give a shout and say if you like this content, please subscribe to the channel. Like the video, send this to your friends so we can get this out there. We got a whole lot left to go in this series, and we'd love for you to be along the ride with us. So please, if you like it, subscribe, join us, and without further ado, let's jump into it. First and foremost, definitions. What is a stock? So a stock represents ownership in a company. When you buy shares of a stock, you're essentially purchasing a small piece of that company, which entitles you to a portion of its profits and its assets. So if you've ever seen the show Shark Tank, when they march on in the Shark Tank and they're like, I want blah, blah, blah for 10% of my company, they are literally buying stock, selling stock in their company to the sharks in the amount of 10% or whatever. That is exactly what you are doing by purchasing shares. Now, in the case of you, it's more like 0.000000001% of the company, maybe give or take a few zeros, but you get my point. When you buy shares of a stock, you are buying a piece of the company, and therefore if the company succeeds, you succeed with it through your ownership. Now, really quickly, I do want to mention that in today's video, I am really only going to talk about what's called common stocks. There is something called preferred stocks, but when most people think of stocks, they think of common stocks, right? And preferred stocks operate pretty similarly to bonds in terms of how they pay and things like that. So long story short, we're not talking about preferred stocks here today, only common stocks. That's that. We're moving on. So how does a common stock work? Like I just mentioned, ownership. So you own a stock which gives you stake in the company, meaning not only can you benefit as it grows, but also you may get the right to vote on certain topics. So they'll send you a little letter in the mail or reach out to you and you can vote on certain topics. Or some companies pay what's called a dividend out to their investors. And if they do that, you are entitled to that dividend as a shareholder. Next, stock prices are going to move, right? So the value of stocks tend to be more volatile, meaning they move more than something like bonds, which is what we talked about yesterday. But these stock price changes are driven by many factors, including supply and demand, which is the big one, earnings reports, economic conditions, and investor sentiment. And on this topic, you guys, I actually already do have a video on my page, on my YouTube page, about how stocks, what makes them go up and down. So I encourage you to check out that video if you want more about this. But moving on, how do I buy and sell stocks, right? It's great that I know what they are and what they do, but how do I get them? Here's your process for getting some stocks. First and foremost, you're going to want to choose a brokerage. Now, if you don't know what a brokerage is essentially like a bank, right? So I'm going to name some brokerages here. I am not recommending any of them. I'm just throwing out some names you might have heard of to give you examples of what a brokerage might be. But a brokerage could be anything from Charles Schwab to Fidelity to E-Trade to Edward Jones to Merrill Lynch to Morgan Stanley. All of these companies I just named would be examples of brokerages. So you open an account at a brokerage, you do your research, you find the ones you want, you move money to that brokerage just like you would a bank, right? So you move money to the brokerage. At that point, you research your stocks, you find out what you want to put your money in, and you simply place an order. You go onto your computer, or at this point, you can even go on your phone and place those trades, and you go to the stock you want to purchase, you place an order, and at that point, you monitor your investments, buy and sell exactly the way that we just described, and that is how you're going to fill your portfolio with stocks. So I got stocks in my portfolio. Now, how do I make the money? There are going to be two main ways you make money with stocks. First and foremost, appreciation. So what is appreciation? Appreciation is when you buy a stock at a lower price and sell it later for a higher price. When you do this, the profit you're realizing is what's known as a capital gain. Now, likewise, when you sell a stock for less than you paid for it, that's what's known as a capital loss. Now, stocks appreciate due to strong earnings, industry growth, or market sentiment, and appreciation is compounding by nature. So what does that mean? When we went over the difference between compounding and simple interest a few days ago, we talked about how compounding interest is when you take the interest and you put it back into the investment. Appreciation, they're kind of doing that for you, right? So they're taking the profits they make, they're putting them back into the company, and that is therefore, hopefully, continuing to fuel that appreciation and allowing that compounding nature to take hold without you having to do anything. Now, you can further the compounding by reinvesting dividends if they are offered. So what is a dividend? I mentioned that earlier, that as a shareholder, if a company pays dividends, you are entitled to those dividends. What is it? So some companies will pay out portions of profits to shareholders in the form of quarterly payments. These dividends are optional and they can be adjusted at any time. So this is not going to be as consistent necessarily as something like interest, right? Interest, usually you know what you're getting and you can count on that. With a dividend, it is up to the discretion of the company. Now, there are companies out there that have long-standing histories of never missing a dividend, only going one way, which is up on the dividend, and they've done that for many, many, many years. So while that does provide a more reliable dividend payment than something that might be a little more sporadic, it is by no means guaranteed like something like interest would be. So beyond that, in addition, you can also get some beneficial tax treatment for dividends if they meet certain criteria. We will cover that in a later video. I will go into more detail about that, I promise, but just know that there are some tax benefits as long as your dividends meet certain criteria. So, appreciation, dividends, all that's great. Why would I choose stocks? What is the purpose of stocks? Why do I want them in my portfolio? Number one, growth potential, right? So historically, stocks have outperformed other asset classes, providing higher returns over the long term. The further out you look, the more significant of an impact this growth potential represents. Now, I have a video coming out in a few days, a week, not sure off the top of this, but I do have one coming out in this series about compounding interest, where we will put on full display how much more damage is done by compounding interest over time. So we will cover that in detail, but just know for now, the longer out we go, the more this factor is going to play in. Number two is going to be passive income. So I mentioned the dividends that can get paid out to you. Some investors definitely look for that passive income to supplement their gains, to offset any losses, and to provide some sort of predictable return to their portfolios. In addition, you can reinvest those dividends to keep boosting those long-term gains and keep that compounding interest working for you. Number three, liquidity and accessibility. So stocks are extremely liquid, usually, as long as they're traded on the major exchanges, right? So stocks are relatively easy to buy and sell on public exchanges, like I just said, making them more liquid compared to other investments like real estate, right? So if I look at something like a real estate, like something like a property, if I want to get the money out of that, I either A, need to sell it, which is going to take some time, especially if I want to get fair market value, or I need to pursue something like an equity option, like a loan against my property of some kind, which again, in most circumstances, I cannot get that accomplished right there on the spot. It's going to take some time. Versus stocks, I literally pump into my phone, click a little button, and it will liquidate at the fair market value right there instantaneously. Again, assuming it's a high quality stock traded on the exchanges. But you will get your money very, very rapidly compared to something like real estate or something that might be a little more illiquid. Now, finally, this kind of plays into all the things we just mentioned, but it is a great way to protect against inflation to buy stocks, right? Because kind of mentioned before with the bonds, one of your risks is that if you have a bond payment, it's paying you a certain interest, that inflation is higher, right? And now you're not earning as much as prices are going up by. Something like stocks can really help you offset that, right? Because they tend to grow faster than most other investments and therefore help you keep pace with inflation and hopefully outpace inflation. And what I mean by that is that your money will grow faster than the price of things around you. So, are stocks risky? Because I feel like they are, right? That's what everybody says. Stocks can be risky. Stocks make me nervous. Are they risky, Alex? Are they? And the answer to that question simply is yes. Yes, they are. Investing in stocks carries a certain level of risk, but the degree of risk largely depends on how you approach it and your personal financial goals. The risk associated with stocks is often necessary to overcome the risk of not meeting our financial goals. Now, I don't want to hang here too long because we are going to talk about this in the next couple days in detail. But listen to what I just said. The risk of not meeting our goals, right? That is, in my opinion, potentially, depending on your circumstances, the biggest risk you face. AKA, your money runs out before you are dead in retirement. You are not able to save enough to pay for your kids' school or to float your retirement or do these things. That risk right there, sometimes we need the risk of stocks to be able to provide the benefits that we just talked about in order to meet our goals, right? So are stocks risky? Yes, they are. They go up, they go down, and there are a lot of factors that contribute to that. But they are often a necessary investment vehicle to achieve our goals. So risky, yes, but a necessary risk. And as always, if you are looking for personal financial advice, consult a financial professional to get that personalized advice. And if you like this type of content, please like the video, subscribe to the channel. We are cruising along here and we'd love to have you with us along the way. And as always, if you have questions, we love comments, so please leave them down below. We're happy to answer them. And until next time, you guys, that's Finance AF.